Welcome back to those of you already with us this morning, and welcome to those joining for the first time. I'm Dan Jones, the Deputy Editor of Investors Chronicle, and this is the next of today's panel sessions looking at investment trajectories for the US. This year, the US stock and bond market has really been driven by the impact of the inflationary pressures we were talking about in our last session. Higher prices and rising rates have sparked a regime change in markets in many ways, hitting growth stocks hard, helping spark a resurgence for a range of cyclical and value investments. More recently, however, concerns about inflation have tipped over into worries about how tighter policy might tip the US into recession. So, it's a pretty complicated environment out there. Things are looking quite tricky, I think it's fair to say, given the market action we've seen this year. And it's certainly a completely different environment to that which we've seen for the past few years and even the past couple of decades. So the big question, as ever, for investors is what's next? And that's what we're going to be looking at today. Once again, a very brief bit of housekeeping before we get going. This session will be available on demand for 30 days, a few hours after we finish. So if you do miss anything or want to listen again, you can do so using the same link that you used to join. We also have an array of useful links, resources, what have you, available through this same screen. And there's a feedback link as well. But on to business once again. I'd like to welcome our panelists for this session. They are Eric Woodward, Head of Investments at Carrington Wealth Management, and Josh Matthews, Co-founder and Managing Partner at Maseko Private Wealth. Welcome, both of you. Let's kick off with, I suppose, the big thing for our audience, our readers, most investors when it comes to the US has obviously been the tech sector. Has produced some incredible returns over recent years. This year, things have gone into reverse somewhat. I think investors have found themselves looking at their portfolios probably quite tech heavy. Certainly those in the UK based who are using the US as a way to get exposure to that theme. Rising rate risks have obviously caused some problems for investors in tech companies, the prioritization of cash flows rather than future growth. So I'd like to start by sort of getting your thoughts on the tech sector, both big tech, small tech, different types. How do you see what we've experienced this year? Can we put that in context a bit? Can we have some thoughts on what might be coming down the line as well in terms of the fortunes of these banner companies for the US market? Eric, why don't we start with you?
Okay, so for me, last year was definitely the year to be in tech, but the market has changed and now values income as interest rates rise, and it's not a homogeneous universe. So you've got the heavyweights, which you've mentioned, and they've not fallen as far, but you have seen some quite massive losses in the software companies, in particular. Financial also has been hit pretty hard in the tech sector. There are some parts of that we think could actually re-rate. In the era of inflation, it's all about whether you can carry price increases and you can generate cash, and that's the bit the market values at the moment. So just looking top down, tech looks to me as though it's still got a little bit further to go down, and particularly those investment funds that are heavy tech. I think at the moment they're going to have a harder time for the next 6 to 9 months. And I think you'll see rallies on the way in the market. But personal view from looking at the market from a technical point of view, I don't think we've seen the lows yet. So I think you'll see some kind of relief rally in tech pretty soon now because it's very oversold. But then I think you will see one final move down as the other sectors continue to make progress higher.
Josh, do you agree with that assessment? What's your view on the sector this year and months ahead?
I think tech's a tricky one. I mean, if you go back to 2000, the largest companies in the world at the time were some companies like Cisco and Intel. And of course, the internet held such great promise for the future. And of course, these were leaders in the respective fields, and they were real companies, right? I'm not talking about the tech bubble of all these small little tech companies that had no revenues or no earnings. I mean, Cisco was the tech darling of the world and largest company in the world. I think it was in March 2000. If you fast forward now, and you've owned that stock for the last 22 years, you've actually lost money, right? Intel and Cisco are both down substantially. And I mean, you could look at Lucent and some other companies at the time. Nokia was another great darling that's lost, I don't know, something like 80 or 90% over the last 22 years. And I think one of the things about technology, which is difficult, is that there's a big difference between a great company and a great investment. Cisco is 3, 4, 5 times larger from a revenue perspective than it was back in 2000. It's just that it could not grow to meet investors' exceedingly high expectations. And I think you might find that being the issue with respect to large tech companies on a go-forward basis. Everybody in the world knows Apple and Microsoft and Google are dominant, amazing companies, which are just unbelievable companies that have very, very large moats and are very difficult to compete against. But realistically, will those companies in 10 years from now be the tech darlings that the largest companies in the world that they are today? Microsoft is one of the very few companies that's been able to reinvent itself, of course, over time, from being a operating software company, the operating system, Windows, of course, to moving into things like Excel and the software packages. And now, of course, Xbox is one of their major, as well as, of course, online services are some of their major products and services. Most tech companies are unable to do that over time, and therefore, even if they're great companies, they might not be great investments on a go-forward basis.
Eric, what are your thoughts on big tech in particular?
Well, I think
the FANGs, but also Microsoft.
Yeah, Microsoft and Apple, I think, are probably still excellent companies. Amazon does look to be having more difficulty, and last year everybody was talking about the cloud, which Amazon and Microsoft dominate in that area. And now that seems the market's attached less value to that part of the business, which is clearly very valuable. It seems that particularly in tech, the areas also that you would have kind of expected to do well with all the supplier shortages is semiconductors have not really performed well in this environment, and there's some dominant players in that sector which have performed relatively poorly, but yet there's good demand, and you'd expect them to have that rare commodity of good pricing power because supply is short. The other thing I just saw.
Sorry, go on.
The other thing which you're definitely hearing across tech and most of the market, as CEOs announce results now, they're talking about 2 extra headwinds. One, which I think you're going to cover off later, strength of the US dollar, and supply chain issues are becoming much more in focus. And supply chain is definitely an issue for some of the big tech companies at the moment.
And how about a question we just had in? Something that worries investors perhaps in big tech is the potential impact of regulatory practices, antitrust, or whether that be US, EU. There's been a lot of noise around these things and a lot of initiatives. It hasn't really affected the bottom line so much so far, but is that an increasing risk as well for investors in these companies? Eric, back to you on that.
Yes, I think it is, and particularly. There's been from Europe, there's been some noises in that direction, and I think they'll see it through. And certainly you're getting more noise from Congress on that. So yes, it's definitely an increasing risk.
Josh, would you agree with that? And do you see, is that an opportunity perhaps for some smaller players to carve out some niches for themselves? Obviously, they've got a long way to go to compete with the big tech giants, but how do you see that impacting things?
I suspect it's a very politically charged question, and I think that you have to have a really good understanding of what's going to happen in the U.S. on the political side of things, which is difficult to know. I think that politics in the U.S. have changed quite a bit over the last 20 years, or even go back to the last 40 years or 50 years ago when they split up, they forced Bell to split up into all the baby bells, etc. I don't know if you have the political power to make that happen. That being said, I really don't have a view as to try and predict what the politicians in the U.S. will ultimately do. and whether the lobbyists will be successful at thwarting any type of political initiatives to break up tech. I think that in general, the markets have started to increase the risk perception on owning tech stocks, and some of that could be related to this political question regarding breakups. I do suspect, however, a lot of it is based on valuations. Again, great companies, but very high valuations. Do you make money as an investor owning these great companies at such high valuations? Question mark. I don't know the answer to that one.
Yeah, I tend to agree with that. Because still very high valuations relative to the rest of the market, and I think that's been the issue that's made you categorized it as value, but it's people are valuing free cash flow much more now.
How does that dynamic, I suppose, interact with what investors are always keen to find, the next big thing for obvious reasons, given the potential return profiles there, in an environment where, it can no longer be perhaps you can no longer pin your entire fate on, revenue growth in the future. You've got to produce those cash flows. How does that interact with, some of the new areas we're hearing talk about, whether it be developments? One question we just had in regarding Internet of Things or medical tech, med tech, or the metaverse even. How can are those areas that are interesting, or is the market environment and the prioritization of cash flows, does that simply make it quite difficult to look at those companies right now?
If we just go back to the cash flow point, I think Eric's right, and I think that's what the market is starting to look at. And it's very interesting because I was having a conversation with a client about this yesterday, and this is looking at some Morningstar data. So I haven't had a chance to vet it as much as I would have liked. But the free cash flow right now of the QQQs, which is the NASDAQ ETF in the US, according to Morningstar yesterday, it was 10.84, whereas the S&P 500 was 10.69, and value stocks were at 8.4. That gap is a lot lower now than it used to be when price to cash flow was much more expensive for NASDAQ stocks. So they have come back a lot, and of course a lot of that is these smaller growth companies, the Spotifys, the Sonuses, the Oatlys, the Beyond Meats, the Zoom, right, that we're on. These are companies that are off something like 70-80% since their 52-week highs roughly a year ago, and have become much more reasonable. We know Netflix, of course, has come down substantially, is trading at relatively modest, if you want to call, price earnings ratios compared to its most last few years. So is tech being a little bit more is it more sensibly valued now than it was? Yes, definitely. And I think price to cash flow is a very good measure to look at when looking at these companies, because that's really at the end of the day what you're buying. You're buying really a future set of cash flows when you buy a stock today. And you want to make sure you're not paying too much for that set of cash flows.
I mean, the market's valued this poorly, but I think there are companies out there like Visa and MasterCard. Now, they've got an inflation built in because prices are going up. Their small cut of that is also going up. So I think the market's been a bit harsh on some of those companies, and Visa in particular has caught my eye. It's traded quite a lot lower, but they have good protection against inflation because the prices go up, so does their cut. And segments which were missing in their revenues in the last sort of couple of years, like airline travel, will come back on stream. And so I think areas like that are probably better risk reward trades in the US market at the moment. I think some of those smaller medical companies, that they're hugely volatile, and even the ones listed in the Nasdaq, like Moderna, it's traded at $400 down, probably to about 140 at the minute. You just can see such huge volatility. I think at the moment the risks are just too high.
What about the other side of the market? Defensives have done pretty well year to date, relatively speaking. By defensives, I'm thinking of utilities, healthcare, staples, even. Is that an obvious place to hide, right now in a difficult market? Josh, what's your kind of view on that?
Well, I mean, Eric talks about risk perception, and typically, by just looking at the volatility index in the U.S., we're recently at high as 35, and just to give you some indication where we were in December is about like 17. At the height of the pandemic, we were like at 80. Before the pandemic, we were typically getting between 12 and 20. The higher the level, the higher the perception of risk, and of course, the lower the VIX level, the lower the perception of risk. At 35 right now, we are of course above multi-year averages, but of course not as high as we were in the pandemic. And I think that right now you have the market, which is basically quite nervous. There's a lot of these issues which we can talk about: inflation, interest rates, geopolitical risk. You have the oil prices, etc. Threat of a recession, of course. So all these things are increasing the risk of the perception of risk. When perception of risk goes up, asset prices come down because investors demand a higher return for owning risky assets. So today we are seeing higher expected returns, if you want to call it, on equities in general than we were at the beginning of the year, because firstly, prices are cheaper, and of course, perception of risk has gone up. So people are demanding a lower price and a higher expected return to own these assets. So it's a very interesting dynamic. And of course, we all know that you typically do get compensated more to own things like equities when perception of risk is higher and perception of risk comes down, as opposed to waiting until that perception of risk comes down, because then asset prices have already gone up. So it's a very interesting dynamic now, and I think investors are quite skittish. You also have the whole everything. I know we're not going to talk about crypto, but clearly that has wiped out trillions of dollars at this point of at least paper gains that some investors had, which is a real number when the crypto market was much smaller and had a market cap of $500 billion and basically fell by a half. That's $250 billion lost by investors. Now it's $2 trillion, which is 8 times that amount. It's a much bigger issue that might feed through to consumer spending, to real individuals possibly losing their houses or other types of things like this, because we just don't know yet how that's going to play out. But I think there will be some ramifications, sadly, from retail investors.
Eric, your sort of thoughts on those valuations and the defensive part of the market and how it's been performing?
Well, you can see obviously the long term is probably not good for the, say, classical energy companies, but they've had massive momentum in the last few weeks, few months, and that doesn't feel like it's going to go away anytime soon. So I suppose you could look slightly beyond that and say, okay, so in the longer term, some of the solar companies and those replacement energies, alternative energy companies should do well. But at the moment, it's hard to see how the oil price will come lower. So the energy sector in particular has got a lot of momentum in it, and yet very unfashionable, but it looks like that still has a long way to go, and the yields are pretty compelling at the moment.
What about we've had a question in on M&A, and obviously when you're looking at a market where valuations have fallen, that raises the prospect of companies getting bought by their peers, by competitors. Are there any areas where you think that's particularly likely to happen? I mean, in the UK market, we're seeing this across all areas really at the moment, but in the US in particular, are there and which one should keep one's eye for a potential rise in deal-making activity?
Well, clearly online gaming is becoming a pretty strong dynamic in the US, so that's one area that's definitely got some momentum behind it. I think you've really got to look in the mid-cap space for that, and therefore you'd probably be better to try and get that exposure through funds rather than trying to pick individual stocks that might or might not get bid for. The other area which there's a lot of interest in, and they've got plenty of money at the moment, is perhaps in defence.
Josh, you're going to agree with that?
On the public to private trade, if you want to call it, it's pretty, it's a pretty cyclical type of thing. And I think there's 2 dynamics that are working here, maybe 3. Firstly, private equity firms have raised a lot of dry capital over the last few years, and raised a lot of capital, and therefore have a lot of dry capital that they can deploy. So that should be very, that should create a lot of buying in that space. The second thing is you have a lot of these technology companies which are still burning through cash flow, are are very, very small in the sense that they have very low revenue. If I take like I don't know, I've just been following Beyond Meat recently because of how interesting that company is. And it's still trading at relatively expensive valuations, but it's down significantly, 70% or more since its highs, but it burns through its cash. So if it's unable to raise money in the capital markets at cost-effective rates, like that kind of company becomes a candidate for a private equity firm to come in and take them out. And you could say the same thing about a lot of these smaller companies like the Oatleys of the world, et cetera, which I mentioned before. You also have a tremendous amount of high yield debt that has been raised in the last few years, which some of that debt is going to be maturing in the upcoming year or two. And we'll see whether or not those companies can refinance those. And if not, you can have distressed players like the Oaktrees of the world coming in and taking a bite out of those companies, or some of those companies going private for much cheaper valuations than we're even seeing today. So I think those are some of the dynamics that are now happening or starting to happen. And I think the ball is rolling in that direction. And we'll see whether or not these smaller companies can raise equity or debt financing when they need it, when their burn rate, if their burn rate continues to be as high as it has been historically.
Not a good example. That's Peloton, isn't it?
Peloton, yeah, is another good example.
Yeah, I think this brings us on to perhaps, the other side of the coin there in terms of, when we look at value investing, which has obviously been out of favor for a long time until, the past couple of years, past few months, really. Value has obviously outperformed considerably this year, as you'd expect, perhaps at a time of rising rates. But now we've got this prospect perhaps of the US economy slowing, which we'll get onto in itself in a moment. How might that affect market dynamics, the balance between growth and value, if you have a scenario where monetary policy tightening tips the US into recession or into a slowdown? How should investors consider that when they're thinking about how to position portfolios? Eric, maybe we go to you with that.
Well, for retail investors, that's been something that's been pushed around, but there are ETFs that focus on quality, and perhaps when some of the other fund managers used to call it GARP, growth at a reasonable price. So I think the investors could think about quality rather than that divide between the cycle of what's growth and what's value. So that's the first thing. And one thing we've just touched upon, I'd also, if I was a retail investor at the moment, I think I would be seriously thinking about having at least half any US positions in a hedge against the currency, because once the US dollar is sort of 120 sterling, I know it could easily go to 112, 115, but the upside downside is quite significant. And if you just stay in an unhedged class, or you're directly investing in US equities, you may find that if sterling reverses, you're going to find that's pretty hard.
Yeah, I think that's a good point. Certainly for UK investors, much of the pain this year might have been masked somewhat by the gains they would have seen on the dollar. Josh, what's your sort of thoughts on, if we're moving into that
Dan,
environment?
you bring up a good question. So to compare value and growth, we really got to go back to maybe around 2007, just before the global financial crisis, when the growth valuations were reasonable. Just as an example, the price to book of US stocks in the growth area were about 4 times price to book. They went all the way up to 11 times price to book at the end of last year, which is an increase of almost 3 times, as you can see. And growth basically made most of its gains simply from the re-rating of the valuations of those stocks from 4 times to 11 times. It's not that they made so much more money over that period of time. It's just that investors were willing to pay 11 times price to book all of a sudden. Now we're down to 9 times price to book, and that's partly why NASDAQ is down roughly 30% year to date, because investors are willing to pay a little bit less than that. Now, during the 10-year period from 2010 to 2020, growth stocks were up roughly over 19% per year in the US, which is amazing, right? I mean, that's an amazing period. Probably, I think, the best 10-year period ever for growth stocks. During the same period of time, value stocks were only up 12%. So they underperformed by 7%. But you made 12% a year as a value investor. So what does that mean? If I probably quadruple my money over that 10-year period as a value investor, so how sad could I actually have been? During that period of time, value stocks only went from like 1 times price to book to like 2 times price to book. So they didn't really increase that much they weren't re-rated that much, so to speak. And now, of course, they have less to fall during a difficult period of time, which is similar to what we saw between 2000 and 2003. We saw growth companies get absolutely destroyed during that period of time. And value companies made a little bit of money. It wasn't value stocks did not do as well as they did in the late 90s, but they still did relatively well. They did incredibly well relative to growth, but in nominal terms, they also still made money. In general, when you have an inflationary environment, value stocks tend to do better than growth stocks and tend to be positive returning. Again, we don't know if this cycle is going to be the same or not, but if history it does repeat itself or rhyme, value stocks seem to be a better place to be during value cycles and as well usually during recessionary periods. Different stages in recessionary periods. I have to hedge that comment a bit.
Sure, thank you. We'll come back to that in a second, but we've had a few questions in on regulation. We've got a new head of the SEC, and I think there's people looking at a number of different areas, be it retail stock trade, be it crypto regulation, be it ESG and sort of a crackdown on greenwashing, that kind of thing. From your perspectives, are these issues investors should be alive to as well? It's quite hard, obviously, to judge the future thrust of regulation, but are these issues on your radars as well? Eric, maybe from your
I think Josh summed it up. It's really hard to call what politicians and regulators do, and they don't always act logically. So I think it's just very hard to call that. You're going to see increased regulation, but how you play it in markets, I think it's impossible to make a sensible judgment on that.
Yeah,
Josh,
I agree with that. I think, however, in the crypto space, which is really, it's not a space that we invest in. It's just something that I watch on the side because, of course, it's so topical. When investors lose $2 trillion over a very short period of time, and you can see, some exchanges are now gating investors and not providing them with withdrawals. You just have to assume the regulators are going to come in at some point, though, and regulate that to some degree, because $2 trillion is a lot of money. And I think that, the ramifications to the economy, et cetera, are massive. And people will lose their houses who leveraged on these various things. Or I don't know if anybody followed the Luna Terra debacle about a month ago, when that stable coin was not so stable as we all know and went effectively to zero over the course of, what was it, a week or maybe even less. So I think that you're going to have regulation there. To what it's going to look like, I don't know, and I think in general, whenever you do have asset bubbles that deflate, whether it's crypto or anything else, and there is a lot of money lost, sometimes there's some things that happen in the background that we're only aware of later, and then the regulators do go back and regulate those type of market practices. So I think that we're at that point in the cycle where we have come down a slope. Do we continue coming down, or do we plateau here and then maybe go up over time? I don't know. Nobody really is good at predicting and timing markets. But in general, I would suspect that you will get more regulation, definitely in the crypto space, and the rest of the market. I mean, we will have to see how that pans out.
Thank you. Let's move on to monetary policy, which obviously is still governing a lot of what matters to investors. And later today, as I touched on in our previous session, we're going to see the Fed raise rates perhaps by as much as 75 basis points. The other aspect of this, though, is not just the rate hikes; it's the quantitative tightening process, the withdrawal of that liquidity of those QE programs. To what extent are those concerns or should investors be concerned, about potential impact that could have on market liquidity? Obviously, again, this is a situation no one's ever experienced before because we've never had the withdrawal of these kind of programs. So it's all finger in the air somewhat. But is that something that investors should be considering alongside rate hikes as a potential impact in the second half of the year? Josh, let's go back to you.
Yeah, I think definitely you have to look at monetary policy and and how that will affect supply and demand, right, for assets. So I think yeah, sadly, when monetary policy goes into reverse, which is of course what we're seeing, that should have a negative effect. I think where we might see this the most is coming back to the issuance of these high yield bonds and high yield debt. There's more high yield bonds and other types of leveraged loans outstanding now than there was before the global financial crisis, just to put things into context. And if those loans cannot be, or bonds cannot be rolled or recapitalized, I'm missing the right word there, that could be a problem for those companies, which of course will have a knock-on effect to other areas. But there are investment pools out there, such as the distressed investors, who kind of felt, this is probably a bad way to describe it, but cheated that the Fed came in so quickly and the central banks came in so quickly after the pandemic. So there will be probably they will have an opportunity, most likely, to distress debt investors in this cycle that we're coming up to. When that happens, how long that lasts, the magnitude, I don't know, but it clearly looks like we're heading towards that. And then I think you have to be very careful and be underweight, probably high yield, and be overweight, good quality bonds, which is what we've been telling investors this for quite some time, and trying to stay in the higher end of the quality on the credit side.
Eric, what are your thoughts on monetary
Yeah,
policy?
I mean, I think the problem, from my grey hair, you can see I've been around for a while, and there are a lot of things that are happening now that do mirror what happened in the 70s, and we're going through that cycle again. The Fed and most central banks and central bankers had not been around in an environment when rate rises were, so most of them hadn't even really seen rate rises, and now we're getting them. Unfortunately, I think the Fed were well behind the curve, and they used words like transitory, but it was hard to see when you've got rising commodity prices and a tight labour market that you don't get inflation, and it just isn't transitory. And so they were slow to realise that, and I think now the risk is, yes, they're tightening, and they're tightening reasonably fast. That's as Josh just said, that's put a lot of pressure on bond markets generally, and credit has also sold off quite aggressively this year. So investors who sought safety in bond markets have actually also suffered quite badly. And now the really hard bit is, well, we know from the input prices that you're not going to get inflation back to the target of 2% anytime soon. So the inflation target is going to miss, and the risk is now that the central banks tighten too much and automatically bring about some kind of recession, which almost feels like that could well be a given now, and it'll be a question of when and how long.
Just on that topic, Josh, is that your base case at the moment? That we do tip over into a recession in the months ahead. How do you see that dynamic?
So there's a few things. Just from an investment perspective, I think that what moves the market the most is unexpected events. And the market is clearly expecting the government or the Federal Reserve to increase rates significantly over the next 12 to 18 months. I think I read yesterday that they're expecting 300 basis points more of new rates. Again, we have our investment committee meeting tomorrow, and I haven't read all the notes. But the point is that the market is expecting a certain amount of interest rate increases. If those interest rate increases need to be increased further to fight inflation, clearly that's a negative for bond prices, because of course they're inversely related to interest rates, and probably definitely for growth stocks, which again seem to be relatively inverted. Prices seem to be inverted as well to interest rate rises. If, however, we start to see inflation moderate, when we're starting to see the next set of results come out, and the Federal Reserve doesn't feel like it needs to increase rates by as much as the market is now predicting, then of course, we might see bond prices start to increase a little bit, and interest rates come down a little bit, or the future interest rates come down a little bit, sorry. And that might be a good thing for the market. So it really has to do with not where we're heading, but where we're heading with respect to investors' expectations right now. That's the first thing. The second thing is, look, this is a theory which may or may not come true, but there has been supply chain issues across the globe, and a lot of companies have gone towards nearshoring or onshoring supply chain, right? So you've had a lot of money starting to be invested in that. Of course, there will be more money invested in this over the near term. But what happens when we have, let's say, factories that are idle maybe in China that are able to supply the same thing that we could manufacture in Mexico or in the States for higher prices? Do you think that those factories in China will just stay idle, or do you think that they'll actually start to promote the fact that they can make the same product for much, much cheaper amounts? You might get to the point where we have so much excess capacity, and I think this will happen probably in the semiconductor business in a year or two or three, because right now semiconductor supply is very, 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 very tight. But what does that mean? A lot of investment now to increase capacity, and somewhere down the road, maybe supply increase is increasing faster than what demand is going to be down the road. This could happen across the globe with supply chain issues, which could lead to I'm not going to say deflation, but more moderate inflation somewhere down the road. But again, it's totally a theory, and I'm not smart enough to know how this is all going to work out, because this is a brand new era, I think, for all of us.
What about the US consumer? This is to me, really interesting topic. Obviously, anyone's ability to withstand rate hikes is limited by how shallow or otherwise those rate hikes are. But the consumer is the driver of the US economy, or so we have gathered over the years. But it seems we've had some conflicting points there. Obviously, you've got tighter policy, you've got the crypto effect perhaps on some consumers. You've seen warnings from Walmart and Target, but perhaps those were a bit more to do with the shift in consumer spending, from goods to services. Obviously, people's appetite, certainly I think it's the same over here, as we've seen with some airport issues recently. People's appetite to travel and to do those kind of things is huge at the moment after the last couple of years. How do you see the strength of the US consumers for feeding into all these issues?
Housing starts are definitely slowing, and house purchases are slowing. The other thing, which is really at the very sharp end of it and is making consumers feel a little more fragile, is gas prices. I mean, we're used to paying a lot for filling our cars, and our cars cost us over £100 to fill now. But there's an awful lot of talk of, well, how much pressure gas prices at $5 is putting on the amount that they're willing to spend in the short term. They're feeling the pain of it going from 2.5 to 5 pretty quickly. So just in pure sentiment terms, that's impacted quite quickly. And I think it will inevitably lead to higher wage demands. I can remember in one of my previous jobs, I was a commodity analyst, and the oil price crashed, and all the drivers got fired, or they went off and did something else, and they were paid an average of $25,000, $30,000. When the oil price rose again and came back, most of the oil companies had to pay between 50 and 75 to get those drivers back. And we saw some signs of that earlier in the year, when there's just such a tight labour market. If you don't get the wage increases, then the consumer, I think, will feel a bit more fragile.
Josh.
Yeah, so like you were saying before, Dan, it's about 70% of the US economy is made up of consumer spending. So it's a hugely important part of the economy. We have also minimum wages that have gone up, but they haven't gone up probably as much as now we're seeing the inflation. We have an issue with mortgage rates. A lot of the mortgages in the US are they're called ARMs, adjustable rate mortgages, that are good for 2, 3, 4, 5, 7 years. And then the rate resets, very similar to what we have here in the UK, but usually for periods that could be up to 7 years. When those start to reset, clearly the interest rates will be higher, most likely, than when the lender took out the original mortgage. That will, of course, constrain their discretionary spending, because they're going to have to put more money to pay down their monthly mortgages. You also have around 32% of the assets in the US owned by the top 1%, and the bottom 90% only own about 30% of the assets. And this is important because the wealth is dispersed across the US very differently than I think a lot of other countries, and of course is top heavy, right? Going into where we are right now compared to where we were going into the global financial crisis, we have assets as a percentage of disposable income at the highest level we've ever seen, but again, not broadly distributed because of what I was just mentioning. And the cost to service personal debt very, 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 very low. So that gap probably does come down a little bit and we start to moderate. Whereas before the global financial crisis, the personal assets as a percentage of disposable wealth, as a percentage of disposable income was roughly the same as the cost to actually service debt. So the point is that gap is much, much, much higher now, which should be good for the economy, but it probably does moderate as the cost of service debt goes up. The other thing is, I think that this is very clear post-pandemic, there's changing tastes. People are spending money on things differently today than they were in the past. And I'm not sure if what we're seeing with Target and Walmart with these inventory buildups do they have the wrong inventory? That's the $1 million question. We know there's supply chain issues and that companies are having a hard time stocking shelves and getting things into the shops. Yet we have Walmart and Target that are writing off inventory, which I don't know, is this because they have the wrong inventory and because of consumers changing tastes? We'll see, and I think this will become clear over the next 6 months, more most likely.
Yeah, I think the old adage of "don't bet against the US consumer," which is one I'm inclined to agree with, but it will certainly be tested over the next 6 months. We'll see how that pans out. We have now reached pretty much the end of this session, but thank you to everyone for taking part, whether you be a viewer, someone who sent in a question, and of course to Josh and Eric as well. Really appreciate what's been a great discussion. A few reminders to finish. We do have the useful links and documents, as I say, and a feedback link as well you can find on this screen. Do stay tuned for the rest of our events, both today and tomorrow, and in future you can find those on the Investors Chronicle website, which is investorschronicle.co.uk. The next session we've got coming up in today's event is on the opportunities in the green economy. That will be 12:05, so we've just got a few minutes break now. But thank you for listening in today. Thank you again to our panelists, and goodbye.
Thank you. Thank you.